the biggest thing that securities lawyers are going to be interested in is watching exchanges try to respond to the challenge, and hopefully creating a form of listing that will be considered a listing on a national securities exchange, but would be rational for Reg A plus companies to endeavor to list on issuance, because that will eliminate the blue sky problems, and that would create a perception of some opportunity for aftermarket liquidity.
One thing to consider, though, we are focusing on the day of the IPO and going public. One of the real problems are, staying public and the cost of maintaining your registration, right, and so I have a easier route to go public through the back door or through the side door, and we're going to call it Reg A. But staying public, do I need to comply with the same Starbucks, with the same requirements? Is that also affects staying public? And if the answer is no, then it's still disconnect. Being in the public domain, you may have an easy way in, but staying there will be as costly as cumbersome.
Well, I think the answer is that the SEC, as part of this rulemaking effort, can create some permanency to a lighter touch regulatory environment. If you list on a stock exchange, it's not likely the SEC will change the regulation as to what that means and the consequence of listing on a stock exchange. You are a full-scale public company subject to the 100-page 10Q and the 100-page proxy statement. I mean, that comes with the territory of being a listed company. If there's some kind of hybrid over-the-counter market, alternative trading platform where you're not technically listed, you're just traded on the basis of this lighter touch Regulation A regime, then I don't think you would be as encumbered as a public company that goes public the traditional way and lists on a stock exchange. There's scope for the SEC to implement this regime. I think there's some reticence. I don't want to pick on the state blue sky authorities, but I think there's some reticence on their part that you can see in their writings. As part of the Jobs Act, there was a study put out by the General Accounting Office just last week on the sort of impact of blue sky regulation on Regulation A transactions. It was a somewhat measured report, but the big takeaway is very high cost, very taxing in terms of compliance. I tasked one of my summer associates to do a blue sky survey of all 50 states in the last several weeks, and I submitted that to the GAO. And the takeaway is about $75,000 in filing fees, as well as about $75,000 to $100,000 in legal fees to fully qualify a Regulation A transaction. So I'm hopeful as the SEC rolls out their rulemaking that voices, so from people like folks in this room, certainly I will be outspoken on this, get the SEC, who has the authority to preempt the blue sky authorities, to actually use that authority.
So hope springs eternal. And by the way, I would like to mention, if you can collect that blue sky bill, I'd like a participation. At present, some of us have a conviction that in order for Reg A plus to work well over time, several elements have to come together. Aftermarket trading in a relatively liquid market, we think is important. The ability to get reliable analyst coverage, we actually think is important. And when we look at the landscape and we look at what is still to come by way of regulation, on the subject that we were discussing just a moment ago, which is the hurdle and the cost associated with being a public company and listing on an exchange, because if you're going to list on an exchange, you have to file a Form 10, 34 Act document, and that is a registration statement, and it essentially undermines much of the significance of availing yourself of Reg A to begin with from a cost standpoint. We're hopeful that the SEC will think about exempting from that and creating a different, as you described, lighter touch form of different disclosure requirements for quarterly and annual reporting. But we think that would be something that could well be a driver. And to the extent we're talking about blue sky, essentially, one of the things that probably is unarticulated, but we all understand, is the best way to render insignificant blue sky requirements is to list on what's called a national securities exchange. And there aren't that many of them now, and those that exist tend to have higher listing standards. So what we are hopeful of is that entities like the Boston Stock Exchange will make a submission. Anybody from the West Coast? Well, you remember the Pacific Stock Exchange? It's a nice building now, but it's not an exchange. We think that needs to be revitalized. And if those exchanges, which evidence preliminary interest in it, are prepared to create a new category of listing, and if they can be viewed as national exchanges for this purpose, you could accommodate Reg A listing, and no worries about blue sky. The only problem is you still have to have a modified current reporting regime. And if you actually pulled that off, you'd really have something.
Well, the clear intent of Congress was to unburden companies, that smaller companies, to access the market. So it's almost perverse to think that you would end up with an outcome where you would put a company into a Form 10 disclosure standard, and hold them to the same level of disclosure of a larger company, because that clearly wasn't the intent of Congress. But the flip side is that in order to, without relief from the stock exchanges and the SEC, what you're saying is that they would get flipped into the over-the-counter markets, right? And that in the over-the-counter markets, you would be fully subject to blue sky filing, state-by-state filings. Is that?
And I concur completely with the view that that's going to make it prohibitively expensive for most of the entities that would otherwise think about doing this.
Yeah, so I think, from BOAS or Greencrest perspective and Second Market's perspective, I think it's, potentially trying to, force the issue of companies going public. And it's not necessarily the companies are demanding capital and access to capital for liquidity and growth, but is it really the best forum for those companies to actually go public? We are trying to create a forum where they can remain private and still access capital in the same manner and at the same scale. So we want to create a new market, a new asset class where highly sophisticated investors are participating in this market and giving these companies the capital for growth and for liquidity as well. So, there are aspects of Reg A that I think will be successful and are probably important for smaller companies. But I think the intent of Congress and the demands from the issuers is really just a means to access capital markets. And is it necessarily the best way for smaller companies to access capital markets by forcing them into the public markets where there's all these complexities that are going to take a long time to figure out?
Well, I don't think anybody's saying would force anybody. I think what you've got is a portfolio of options that have been created by the Jobs Act, and some people like vanilla ice cream, some people like chocolate ice cream. There's going to be a different solution for different folks, and there's clearly going to be a lot of companies that don't want public level disclosure, and for competitive reasons even they want to stay private, and I think in the private markets you have the tool, which is to say that you only have to disclose what you have to disclose to get what you want to get done, right? So Facebook arguably didn't have to disclose much.
Right.
There was a lot of natural demand there, but in the public markets they would be subject to whatever standards of disclosure are set by.
Yeah, I think it's important to give the optionality to the issuers, and I think it is what would be preferred, but the focus of the reforming the regulation is around the public markets, whereas we feel the focus of the regulation should be in the private markets and creating an ecosystem and infrastructure for companies to remain private and to get the liquidity and capital they need.
But one thing everybody could agree on is if the regulation to be determined doesn't address the issues we've been talking about, it's going to create, hopefully, more opportunity for companies like yours. And one could easily see that being the outcome.
What we see as a result is that companies are aware of the different options they have in the private space, and whether it's board of directors, whether it's management, they all acknowledge the fact that probably time for IPO is being extended. So they should at least look at what's available in the private space. IPO may not probably take place next week, maybe not next quarter. What are the options? How do we keep our investors, our employees motivated for the next year, 2 years, 3 years, maybe 4 years until we go public? Liquidity is required. How do we go about that? And what we see, managements are getting more involved in the process. So if you look at Facebook example or LinkedIn example, where the companies were not involved in those secondary trades, it happened between a motivated seller and a motivated buyer through a second market, standing in the middle and kind of channeling the traffic. And the company was not involved. They kind of, they took the approach of don't ask, don't tell of what's going on in the private market. What we see now, our management are getting more involved, and they proactively think about utilizing private markets to provide liquidities, to allow shareholders to maintain their position until and if they go public. So what we see on our end is companies actively arrange for private rounds for shareholders, getting involved in shareholder liquidity programs. We are involved currently in more than probably more than 10 initiatives like that, where companies actively said, okay, we're going to stay private longer, but we need $50 million or $100 million or $20 million of liquidity. How we go about that, and how we tell the story, how we do a roadshow, how we talk to investors. So management and the companies themselves are taking more control over the process in the private domain.
Which gives rise to an observation that responds to one of your questions: what needs to be done to make Reg A Plus work best? And at present, we're all uncertain whether one is going to be able to affect a secondary offering under Reg A Plus. And if, as one would expect, that's included at the end, that's going to be great. But if it isn't, markets that won't be served would be VC portfolio companies where there's some investor fatigue, or they need to liquidate, or where you have employee founders who need some liquidity and companies not ready for public offerings. So that's another thing to put on your checklist of things to be done in connection with the regulations being written.
Right, but the Jobs Act, it's not necessarily the Reg A, but this is the increased number of shareholders from 499 to 2,000.
Yeah, you're talking about on the private side.
On the private side.
All I'm saying is one of the impetuses for for small companies doing deals often would be that they are held by people who would like to exit the investment. And right now, that's not part of the way the world is thinking about it.
Let me throw a little bit of a wrench at you, because it's going to affect everybody up here on the podium, which is this whole notion of integration of offerings, which is the sense that if I'm an issuer, I may want to track, I don't know if I'm going to get an IPO done, I don't even know if I'm going to file it, but I may want to do it if the market's open, and I'm going to conduct myself like I'm going to do an IPO, or it could be a Reg A offering or something. But in the meantime, I'm meeting with investors, I'm getting crossover buyer interest in there, so I want to swap and do a private placement, Reg D private placement, as I'm tracking to go public. And I've now got an SEC that's saying that we can see published research prior to the offering, through an IPO, into the aftermarket. What should I be concerned about around the whole boogeyman of integration of equity offerings? Is this thing good? Yeah.
We'll have a blog out tomorrow called Integration Disintegration. And it's our expectation that the way things are going, integration may well be an irrelevant notion in another 9 months or so. I'd assume that's a minority view.
That's from your lips to my ears. But my sense is the SEC is not going to let it go that easy. As Jim, you probably lived through the metaphysics of the 1990s and how that and that really did disrupt the market on integration. So,
what are the concerns with integration for the audience?
Well, were they historically, or?
Well, I guess I'll also try and summarize. It's when you have discrete transactions. We'll take an example of a private placement and then followed by a public offering. The SEC has got a interpretive policy that can suggest that you collapse those two distinct transactions and you treat it as a single transaction, and essentially would render your private placement that came before the public offering unlawful, contrary to the statute. And so there's a bunch of criteria where the SEC has outlined how it views offerings and what you need to assert to separate them properly. It bedevils guys like myself and James and counseling companies, particularly in the run-up to a traditional IPO. And so in the Jobs Act, which was quite innovative on the part of Congress, they allow the issuers and presumably the intermediaries acting on behalf of issuers to go out and test the waters. Essentially meet with institutional investors. This is not for the general investing public, but your so-called qualified institutional buyers, your sort of super accredited investors, if you will, where you can assess their appetite for an investment in the public offering that is yet to be announced. And I think what David is positing is, well, what if you were testing the waters more generally? I'm thinking about an IPO, I'm thinking about a private placement. Can you have that divergent sort of viewpoint and not run afoul of this potential integration point? I have my legal opinion based on how I would assess facts, and I think you can thread the needle and avoid the problem. But it remains to be seen exactly how the SEC expresses its view on this. And if it disintegrates, as James suggested, then I'll pop the champagne cork, because my life will be a lot easier.
And because we've all been dealing with highly impressionistic, not particularly rational restrictions. There have been a couple of no-action letters in the area, which are just arbitrary and not based on anything we would understand to be basic principles. See, our thesis is that the more you allow exchange of information before a transaction, the more, and the greater the extent to which you believe it necessary to level the playing field. So, for example, sure, this guidance will permit testing the waters with institutional investors, but if you move almost immediately to an offering, how much of a leg up will have they had over the investing public, which will need a fair bit of time to digest also. So ultimately, leveling the playing field is going to be important. Ultimately, the Congress and the staff have already evidenced an appreciation of the importance of this analyst exchange and communications. And so we see it as very hard to maintain the traditional integration rubric when all of the rest of these things are changing, but I guess we'll live and learn.
I want to thank the panelists, and we're running late.